What's going on, everybody? It's Stas here. So we got to talk today. We got to talk about the Fed, Jerome Powell, interest rates, tapering, how this is going to affect the stock market, and not only the stock market, but all of the markets out there. Crypto, the housing market, even though I'm far from an expert in the housing market, crypto market, we're going to talk about it today, guys. We're going to talk about it and go over my thoughts on all this stuff and how I'm preparing for it. So if you guys find value, hit the like button, subscribe, check out my Patreon down below for all my real-time moves in the markets, and don't forget to get your 50 free bucks from M1 Finance, which, by the way, that's limited time. Get your 50 bucks right now down below in the description box. And with that being said, let's get into it. So once you realize this one thing, you are going to be set in not just the stock market, but the markets in general. This one thing is the Federal Reserve. It's not the only thing that determines everything, but it really determines where the markets are going to be headed, right? The Federal Reserve plays a massive role in the markets as a whole. Crypto, the stock market, the housing market, the economy in general. The Federal Reserve is pretty much everything. I'm just going to come out and say it. It's pretty much everything, and you guys probably know that. Maybe you don't know that, but the power they have is insane. The way that they can manipulate the interest rates, well, it's not really manipulating, but them raising the interest rates, lowering the interest rates, they can manipulate the markets, right? And the way that they just buy bonds and add to their balance sheet, taper the bond purchases, quantitative easing, quantitative tightening, all this stuff are ways that the Fed kind of pulls the strings, right? And that's kind of what they do. They pull the strings, and again, the sooner you realize this, the more successful you're going to be, the sooner you will become successful or have more of an understanding of how things work, right? And the last time we saw an interest rate hike, if you guys recall, I mean, a lot of you probably started in the markets in 2020, but me personally, I started probably in 2014, 13, right around that time period. So I was around in 2018, and I was making videos back then. I think I started my channel in like 2017 or something like that, October 2017, if I remember correctly. We saw the Fed hike up rates Christmas time of 2018, if you guys remember, and I'll zoom in right here. You can see what happened during that time period. And if you guys remember this, drop me a comment down below. I think interest rates were like maybe 2% at this time. I forget exactly. But SPY, during this time period, look at where my arrow is, if you can even see it. Back in September of 2018, SPY was trading at 293. And then they started to increase rates, I believe, right around here. And that's when we saw a bear market, or pretty close to a bear market, heading into Christmas. I think it was Christmas Eve, right around there. We actually bottomed out, and then we started running back up when the Fed actually reversed, their, interest rate hikes or whatever. And then we obviously know now we're at zero, fast forward a couple of years later. But you guys can see we went from 293 in 2018, end of 2018, to about 233 it bottomed out, which was about a 20% bear market. Very quick bear market, and then again, like I said, we ended up bouncing back. And now, again, we're at 0% interest rates. So that goes to show, when the Fed tries and hikes up the rates a little bit, the markets react like that. The markets tank. The markets take a hit, because what you guys have to understand is when interest rates go up, the value of you saving your money in a savings account becomes more valuable. It's more worthwhile to put your money away. So people were pulling money out of the markets, and when interest rates go up, growth stocks, their future value, their future earnings get impacted. We've talked about this a lot before. That's why when interest rates go up, it's better to own assets that make money and have value today in the present time, not assets that have most of their value projected into the future, which is a huge topic topic that we could dive into on a whole video in and of itself, but we're not going to get too deep into that right now. And you guys can see, I mean, when the pandemic hit, we went to 0%, all the quantitative easing, and you can see how the markets reacted. So pretty much it's like a lever, right? If interest rates are shooting up, the stock market, housing market, crypto, it's going to be affected negatively, right? At least in the short term. We're going to see a big dump off in the markets, and it's the opposite when interest rates go down. When interest rates go down close to zero, now they're at zero, and Trump wanted them to go negative. If you guys remember, Trump was like telling Powell, oh, you dump the rates to zero, dump them to negative, which they're not negative, but when interest rates go down, markets go up, right? So now we're seeing tapering, right? The bond purchases are going from 120 billion a month, and they're dropping each category down 5-10 billion per month or something like that. You guys remember. So we're starting to see the money not dry up completely, but slowly coming away. And now we know that the Fed is going to increase interest rates at some point in 2022, and some believe multiple rate hikes in 2022. Some believe they're not going to do it in 2022. Some of the officials say 2023. And I do have some notes here about that. So Fed Reserve Vice Chairman Richard Clarida, I hope I'm saying that right, probably not, said his view that the criteria for a rate hike could be met before the end of 2022. And Clarida acknowledged the increase in inflation this year was more than a moderate overshoot. No kidding. We've been talking about that on the channel for months. And the target for the Fed was 2%, which we all know we're well above that now. The CPI is like 6.2%. That's the way they track it. It's probably more like 10% if you're, actually looking at the real rate of inflation. And he stressed that the Fed is watching very closely when it comes to this inflation. And to battle inflation, you have to increase rates. That is one big way that you could battle, the main ways you could battle inflation. And now we have St. Louis Fed Reserve Bank President James Bullard saying he sees two interest rate increases before the end of 2022, but half of his colleagues still don't expect the first rate hike until 2023 based on his most recent forecast in the FOMC dot plot, which probably came out, I believe that was the most recent Fed meeting. And then we have Patrick Harker, the president of the Philly Fed Reserve, who also said the Fed might have to act before 2023 if inflation does not ease. Then we have the Chicago Fed Reserve president, Charles Evans, viewed as one of the more dovish members. He indicated that the Fed could speed up the pace of tapering if conditions warrant, and he also left the possibility open of the Fed moving up rate increases. So we're seeing a lot of these prominent figures in the Fed across the country, multiple different figures. We have the Philly Fed president, St. Louis, we have Chicago. A lot of them, some more dovish, some more, hawkish, whatever. They believe interest rates are coming up, and they're probably not going to go to 2-3% very quickly, but we're going to see the 0.25% hikes, 0.5% hikes. And like I said earlier in this video, that's going to affect the markets. We are going to see some sort of drop. It's coming. You got to be prepared for it. And the earlier you realize that, the better off you're going to be. And some people are like, Stas, the markets are already pricing in interest rate hikes. I don't really think they are, to be honest. They are pricing in tapering. We are seeing the tapering. The markets realize that. And don't get me wrong, the markets know that interest rates are coming, but I feel like the markets are playing this game like, okay, we're going to time the interest rate hikes. We don't know. We don't think they're coming yet, so we're going to be in the markets for now. But once we realize interest rate hikes are next month or a month or two from now, 3 months from now, then we're going to start seeing a bit of probably a drop, and this could happen early 2022, maybe mid 2022, when the market finally wakes up, smells the coffee, and they're like, okay, inflation's hot right now. It's been hot. The Fed's coming in hot. They're going to increase rates, and that's going to cause the drop. So the way that I'm preparing for it is, I'm not completely getting out of the markets. I don't like doing that. History shows that if you missed, the best 15, 20 days, you guys have heard that stat. If you've missed the best 15, 20 days, your returns are a lot lower than if you were in the best 15, 20 days in the market. So I'm not getting out of the market, selling everything. I'm not some kind of doomsdayer, but I am building a healthy cash position that I'm holding on to, right? And I'm going to be waiting to see if we get a 20, 30% drop, maybe 10, 15, 20%. And having cash is a position. And I know that might sound basic, but that is a way that I am preparing. I have cash for the short term that I'm not going to be holding for 5, 10 years, but over the next 1, 2, 3 years, I think it is wise, even though we are seeing inflation, to have some cash on the sidelines that you're going to use for short-term, or not short-term investments, but longer-term investments if the market does come down. So that's the main way that I'm battling it. And on top of that, I'm investing in stocks. A lot of my holdings are stocks that make money today. Don't get me wrong. I do have my growth stocks, but I do have blue chip stocks as well that have earnings today, and those are not going to get hit as hard as companies, like I mentioned earlier in the video, that all of their earnings are projected in the future. That's why you're seeing, in my opinion, a lot of these growth stocks getting hit, because a lot of them are probably starting to price in rate hikes coming very soon. We're talking about stocks like maybe DraftKings is one of them I made a video on recently. PayPal could be one of them. Tattooed Chef. These are companies that are probably going to get hit. I don't know how much or if those particular stocks are going to get hit very hard, but you guys have to realize this stuff is real. Prepare for it. And let's see how long we're in here. We're probably in about 10, 11 minutes, 12 minutes. So I'm going to wrap it up here. All you have to know is the Fed controls the market. The sooner you realize that, the better off you're going to be. So if you guys found value, hit the like button, drop me a comment, let me know your thoughts, and subscribe to the channel if you want to hear more real content like this. No fluffy BS. It's the real stuff here on the channel, guys. So subscribe, hit the notification bell, check out my Patreon down below if you're interested. Get your $50 from M1 Finance. As always, that's limited time. Get your $50, link down below, and that's it. I'll catch you all in the next video. Thanks for watching. As always, keep crushing the markets. Stay safe out there. Peace out, guys.